right now, as of 9:40 a.m. Eastern Time on this Friday, November 14th, 2025, shares of Nuburu Inc., ticker BURU, are trading at $0.2462 per share. That is a sharp drop of 15.84% on the day, a loss of more than 4.5 cents. This move is happening on significant volume, with over 4.4 million shares already changing hands, and the market has only been open for 10 minutes. Now that price action is a brutal reality check, and it immediately creates a massive disconnect for anyone who was watching this stock just 2 days ago. The expectation, the story that was being pushed, was one of transformation. On November 12th, Nuburu announced a renewed strategic partnership with Techni, a European defense contractor, complete with a €15 million investment commitment and plans to expand globally. The stock surged on that news, and for a moment, the narrative seemed to be about a high-tech company successfully pivoting into the lucrative defense and security space. Investors saw that headline and thought, "This is it! This is the turn." But today, that entire rally has been erased and then some. The market is aggressively selling into that news. This isn't a buy the rumor, sell the news event. This is the market flatly rejecting the story. The question is why? What is the underlying reality that is causing today's 16% collapse, and what do investors who jumped in 2 days ago not understand? Let's establish the common ground, the story you'll find on most basic investing sites. The belief is that Nuburu is a cutting-edge industrial technology company. They are, or at least were, a pioneer in high-power blue laser technology. This isn't just a gimmick. Their specific wavelength is apparently very effective at welding reflective metals like copper and aluminum. This has huge theoretical applications in building electric vehicle batteries, consumer electronics, and 3D printing. With the world moving toward e-mobility, this sounds like a perfect pick-and-shovel play. That's the expectation. You see blue laser and EV batteries and think of high-growth tech, maybe the next NVIDIA stock or something with Tesla stock-like potential. But the reality is that this core business has been a complete commercial failure. When you look at their financials, the trailing 12-month revenue isn't in the millions. It's reported $9,300. That's not a typo, 9,000. Meanwhile, the company's accumulated deficit has ballooned to over $150 million. The original blue laser business, while technologically interesting, is not a functioning revenue-generating operation. This financial reality is the key. The company is in a fight for its very survival. The entire pivot to defense isn't a strategic choice to maximize profits. It appears to be a desperate last-ditch effort to find any business model that can attract capital and keep the lights on. This brings us to today's trading. That 16% drop isn't panic. It's a cold, hard calculation. The market is looking at the €15 million commitment from the Techni News and weighing it against the company's going concern warning. This is a formal declaration from the company's own auditors filed with the SEC stating that there is substantial doubt about Nuburu's ability to continue operating for the next year. As of its last major filing, the company had just over $111,000 in cash on hand. $111,000. That is not enough to run a public company for a week, let alone fund a global expansion. The company's Altman Z-score, a metric used to predict bankruptcy, is a staggering -148. A score below 1.8 indicates high distress. Nuburu's score suggests it's already functionally insolvent. So where is this €15 million coming from? And how is the company even paying its executives? The answer is dilution. This is the reality that crushes shareholders. In the past year, Nuburu's total number of shares outstanding has grown by an almost unbelievable 1,793.6%. Let me put that in perspective. If you owned a piece of the company, your slice of the pie has been cut into nearly 18 new pieces, and you still only own your original tiny sliver. The company is surviving by printing and selling stock, likely through at-the-market offerings, to anyone willing to buy the turnaround story. This is why the stock price is in the pennies. Every time there is good news, like the Techni announcement, new shares are likely sold into that strength, pushing the price right back down. This creates the chaotic, volatile trading pattern that attracts day traders using platforms like the Robinhood app or SoFi Invest, but it is toxic for anyone attempting long-term online investment. This is not a stock for a Fidelity mutual fund or a professionally managed Schwab Intelligent portfolio. The institutional ownership is almost zero at just over 1%. The general public, that is, retail investors, holds over 94% of this company. This means there is no floor. There are no large, stable funds from Fidelity Investments or T. Rowe Price holding the line. It's a pure retail-driven play, which is why it can jump 20% one day and crash 16% the next. The stock is a trading vehicle, not an investment. The volatility is extreme. This is the kind of stock where you need a sophisticated interactive broker's platform to manage your risk, not a set-it-and-forget-it individual brokerage account. Now let's look at this transformation itself, because the reality is even more concerning. The company has announced a flurry of activity. It's not just the Techni partnership. It's a joint venture with Maddox Defense to build military drones. It's the acquisition of a company called Orbit SRL to build out a defense and security hub. It has also appointed a new dual CEO structure to manage this change. This all sounds very busy and productive, but the market is looking deeper. In October, Nuburu received a warning letter from the NYSE American Exchange. Why? Because it announced its new co-CEOs during trading hours without giving the exchange the required advance notice. This is a basic, rookie-level compliance failure, and it signals a level of internal chaos that frightens serious investors. But the most alarming part is the Orbit acquisition. Nuburu announced it was acquiring 100% of Orbit. But who owns Orbit? Public filings show it is wholly owned by Mr. Alessandro Zamboni. Who is he? He is Nuburu's new executive chairman and new co-CEO. This is a related party transaction. The company, which has only $111,000 in cash, is using its resources, likely financed by that massive 1,793% dilution, to buy a company from its own new chief executive. This is a monumental red flag. The market sees this and doesn't see synergy. It sees a potential draining of corporate assets. It sees a company that is in a desperate going concern situation, engaging in complex deals with its own insiders. This is the kind of detail that someone engaging in self-investing might miss if they're just reading headlines, but it is the entire story. The original business model, the blue laser technology, is all but forgotten. That was the expectation. It was a clean, high-tech story. But the reality is a pivot to a defense and security hub that is being built by acquiring an insider's company, funded by catastrophic dilution, all while staring down a going concern warning and NYSE compliance letters. The company is burning through cash it doesn't have, and its TTM revenue is less than what one person makes at a fast food job. The stock is trading under 30 cents, putting it in constant danger of being delisted from the NYSE for failing to meet the $1 minimum bid price. Looking forward, what is the path? The expectation that the company is trying to sell is that one of these defense deals, Techni or the Maddox drone venture, will land a massive multi-million-dollar government contract. That is the lottery ticket. If that happens, the stock could move significantly. But the reality is that the company is in a race against time. The most likely next step is not a huge contract, but a reverse stock split. This is a cosmetic move where they'll take, for example, 50 or 100 existing shares and combine them into one new higher-priced share. This is done to get the stock price back over $1 and avoid being delisted. It does not create any value. It simply reduces the number of shares and is almost always a sign of a company in deep, deep trouble. It's a move to maintain the listing so they can continue to sell more shares and fund this high-risk pivot. This is a very dangerous situation for the average person looking to invest online. It's a story that highlights the difference between a high-concept narrative, blue lasers for EVs, and the brutal reality of a balance sheet. This is why getting investment help or using a tool that shows you the full financial picture, like those available through Fidelity or Interactive Brokers, is so critical. A simple app might just show you the